All right, welcome back. Welcome back to another video. I think this is my sixth video on this. Um, I this is gonna be like a series or something of me working on accounting questions from the accounting book. Speaking about the accounting book, I think this is the book. Yeah, it's called Advanced Accounting, Beams 13 edition. And for today's video, I'm going to be talking about questions 6.8 and 611 from the book. So, you know, let's just get into it. For the first question, we have the main topic is depreciable assets upstream sale. So, let's kind of dive into it, you know what I mean? Okay, we have Maiba. So Maiba here is the parent. Japera is the subsidiary. And the parent, essentially, they purchase a vehicle from the subsidiary for this much, 2.8 million. At the time, the vehicle had a book value of 2.3 with accumulated depreciation of 200. They use double declining method of depreciation and has an estimated remaining life for 10 years with no residual value. So it's going to be like all gone after 10 years. Uh, to In the same year, the subsidiary reported net income of 3.8. Now we need to get the depreciation expenses that should be eliminated and the income. So the thing here is that basically what the first question means is that the idea here is that the parent and the subsidiary will have their own kind of like bookkeeping, right? As they should. However, in this case, the subsidiary records their vehicle for 2.8 for 2.3 with an accumulated depreciation of 200, while the parent recorded the vehicle for 2.8. So there is a difference between those two. And because those two numbers are different, depreciation for the two must be different as well. And those differences should be eliminated when consolidating the companies, so from the subsidiary to the parent. But then you also need to consider I guess the non-controlling interest as well in this question, because it's an upstream sale, so from the subsidiary to the parent. What I would start with is to first let's go here. We have the selling price of 2.8, book value, accumulated depreciation, and here I calculated the net book value of the vehicle. What it means by net is that basically, because you have like accumulated depreciation here, like how the vehicle depreciates, that means it should like reduces the value of the vehicle. So in a way, the net book value of the vehicle should have been like 2.1. And so we can then use this 2.1 to compare with the 2.8 that the parent records. And from there, we can easily find the unrealized gain. Obviously, because the vehicle is 2.1, but then the parent acquired it for like 2.8. So there's like the unrealized gain, or like profit, if you want to think of it like that. After finding this, we want to then find the depreciation on 2014 on the vehicles from both perspective. Remember, like for question one, we want to calculate the differences between the two. So we want to calculate depreciation from the buyer's perspective, the parent, and the seller's perspective from the subsidiary. And so what I did here is I used the double declining method. If you want to know more about this, basically I'm just gonna search it up here, but double declining balance depreciation formula is something like this, so 2 times. Oh wait, might not have been this. But what I used for this question is that I essentially I use the number 2, right? Double. That's the idea. Over the lifetime of the assets. In this case, it's like 10 years, and I multiply it by the selling price. That'll be the depreciation for each year, for the first year. And so I did that for both, but then for the seller, I used the 2.1 instead of 2.8, and then from there you just find the differences, which is like 140. This means that in the consolidation, 140 should be eliminated from the depreciation due to the differences between the buyers and the seller's perspective. So it should be eliminated. That's for number 1. For number 2, we then need to calculate the income. And in the questions, they already report an income of 3.8 like this. But then keep in mind that Maiba only owns 80%, so that means there is like the other 20% that we call non-controlling interests. But what we need to pay attention to is the 80%, since we own 80% of Japera. And so in here, what I did is I calculated 80% of the 3.8, which is this amount, 3,040,000. Sorry for the notifications. Just gonna ignore that for a moment. After that, what I did here is that I readjusted with the unrealized gain. Again, we have this unrealized gain, from the sales of this and this, right? 2.1, 2.8. But the problem here, it's not really a problem, but then the thing here is that since we only own 80%, the unrealized gain that the parent should account for should also be 80%, not the whole 700 of unrealized gain. So you multiply that with 80%, and you should get this. And so that will be the income from Japera in the 2014. I guess that should answer the first question. We can then move on to the second question about the consolidated net income. And this covers both upstream and downstream sales. So this is very good for practice, I believe. And so these are the informations provided, the income, and there are some like transactions here. And basically we needed to prepare a schedule to calculate the consolidated net income of, we need to calculate the consolidated net income, but we need to make a schedule. So I have prepared, for this video, I prepared the schedule. Looks something like this, and then you have like the consolidated net income and the controlling share net income. But let's go from the beginning. So I've also put like a couple of informations here that I thought would be relevant in solving the schedule, the problem. And so first I put the income from the separate income from the parent and the subsidiary, in which in this case PAM is the parent, Sun is the subsidiary. So these are their incomes, and we want to simply combine them because it's consolidation. So you want to combine the income. After that, you want to make adjustments which are based on the transactions here in the problem that they give. So maybe first we can talk about this first. 40,000 was assigned to a reduction of planned assets. So in a way, this means that because they purchased it for $40,000 less than the book value, those excess should be amortized for 10 years. And since the total is like 40,000, that means that you should amortize 4,000 each year, to make it to 40,000 by the end of the 10 years. And so throughout the year, from 2016 to 2019, maybe until like 2026, you should keep adding these amortizations like this. So this is constantly being added up, right? Aside from that, we also need to adjust for what we call unrealized gain on land, because one of the transactions here is that Sun sold land that costs 25 to PAM for 30, and then it was resold in 2019. But then there is like a gain on the land itself, right? You gain like 5,000. You gain around 5,000, and that should have not been realized at first. It should have been realized when the land was resold again. So in here I just put Uh, wait, hold on. I think I might have like did something wrong. Uh, it should have been it should have been should have been the land, not the yeah. It should have been that. My bad. Okay. Yeah, this too. Yeah. Okay. So because we have a gain of 5,000, but then we don't want to realize that first because it's we have to realize it by the time the land was like sold again, and so we don't want to realize that in 2016. That's why we like reduce it, like we deleted it in a way, and so that should make up for the income in here. And so I'm not gonna go to the non-controlling interest. I'll go to that later. And on the second year, on 2017, there's also a transaction for machineries, which had a book value of this, but then they sell it for this, which means that they have profits, right? Profits, gain, that's what they call it. But then the same goes for land. You don't want to realize that gain first. You want to realize the gain later on. But in the case of machineries, it's a bit different in a way that the machinery that the company bought is being depreciated. And basically, what it means is that it has a lifespan, right? And it will gradually reduce and it will like be gone by the time the life like the life of the machine is over. In here, they said that they sold for 100,000 and has a depreciation of 20,000. Using logic, this means that if 20,000 is the depreciation, within 5 years it will go like to 100,000 and will completely reduce the machine. So the lifetime for the machine is like 5 years, right? And so what we want to do in order to realize the gain on machinery is instead of reducing by $25 or $25,000 here and then like putting $25,000 in the end, what you want to do with this is to uh, gradually put back the 25 in, according to the lifespan, I guess. In this case, if we have 5 years, that means that we want to put like we want to return $5,000 each year, so then by the time it's the fifth year, it's already like the $25 that was once unrealized is already fully realized. So we want to do that when it comes to these type of fixed assets that that depreciates. It's a little bit different than land, right? And so this is what I did. And with this 5,000 will basically go on until the fifth year, so around to 2021. So it has a similar characteristics as this, like in a way, although it's like different. And that's for 2017, so you should add this, and reduce the unrealized gain, right? For 2018, you're still doing the same thing with the amortization. You still include the gain on machineries. However, there's an additional transaction in which they have an inventory. The parent has an inventory with an unrealized profit from merchandise acquired from the subsidiary. So we have an unrealized inventory profit here. It's very straightforward. When you have things that are unrealized, what you should do first is to reduce the income. Why? Because basically the income that they reported in 2018 here is already included. It's already the unrealized profit is already included in the income. It's like that, and since it should be unrealized and should be realized like later on in 2019, that means that in 2018 you should reduce like by the unrealized profit. So that's why it's like negative here. So they should reduce. This will be the net income. And so in 2019, since the land is sold, the inventory is also sold, you're gonna add those back. At first you have the 4,000 for amortization. Very usual. You have the unrealized gain from land being like reverted back. So like if this is like negative 5,000, this is positive, right? You're returning it back to here because it's already sold. Let me just put it like sold, right? And this also sold. We have gain on machineries, which goes on until 2021, and you have unrealized inventory of 8,000 because in 2019 the inventory has been sold, so you should like realize that the gain that you previously have. So that's why, and that should make up for net income of this. The next step here is quite simple, which is to calculate the non-controlling interest, in which what you basically want to do is to uh, calculate the income from Sun, the net income from Sun alone, so without the PAM, and then you want to multiply it by the non-controlling interest ownership, which is 20%. And so this part can be a little tricky because the transactions in the case are not, all of it are not, some of it are downstream, some of it, one of it is like downstream, and the other two is like upstream, I think. The land purchases is upstream because it's from the subsidiary to the parent, as well as the unrealized inventory. But then the machinery was sold from the parent to the subsidiary, so you don't really need to adjust the. It doesn't adjust the Sun income, rather it adjusts the PAM's income, the parent. And so you want to calculate that, so 60 added with 4,000 reduced by 5,000, and you multiply by this, the NCI. You do the same thing for the other year. You see what I mean? In this case, you use the inventory, and then you use the inventory as well, and that will, once you find these, you basically want to reduce this by this, and you should get the controlling share of net income. So this is the net income that will be reported by PAM, as the consolidator, because they're the parent company. So they will report a controlling share of net income of this. Wait, yeah, I think that's the answer. If you want to know what is the proportion of like Sun's income that they own, basically you want to calculate like 60 minus 11, this like this. So maybe I can do it like a little bit here. Maybe you should just go like this. So this is like the, so portion, controlling portion of Sun's income. Yeah, if you want to calculate that, there you go. That's how you do it. And that also marks the end of the video. I think I've answered all the 2 questions. Please do let me know if I did anything wrong, or if maybe like I did everything correctly, but then my methods are wrong. Maybe you can like tell me, anyone. You can tell me in the comments, or since I'm also like doing this for my lecturer, maybe you can also give a comment on the video on the, maybe you can tell me as well. But yeah, I'll see you in the next video with questions from chapter 7. All right, see you.